Some developers in Portland say hundreds of potential housing units are sitting idle right now, and they claim one city rule is largely to blame.
News Center Maine's Alex Haskell joins us live with more details. Actually, we just lost Alex, so we will tell you what he was about to say. In fact, he was going to talk about addition to rising construction costs. Some developers say that Portland's inclusionary zoning ordinance is stalling housing construction across the city. The voter-approved measure passed in 2020. It requires all housing projects with 10 or more units to set aside 25% for lower to middle-income households or pay a fee of more than $180,000 per unit instead. Supporters of the rule say it's meant to help increase the supply of affordable housing in the city. Jonathan Cully is the managing partner at Redfern Properties, which manages about 1,000 apartments across Portland. He says another 1,000 units are sitting on the drawing board, stalled in part because of the city's inclusionary zoning requirements. So Alex asked him why developers don't just build the affordable units or pay the fee.
The problem is developers rely on banks and investors to build housing, right? And so we can't just say, oh, we're gonna do this for free or we're gonna do this at a loss, right? Like we're not able, the private market's not able to do that.
He adds one possible solution is increased public investment in housing, and that the city of Portland has hired a consultant to evaluate whether the ordinance is achieving its goals. Because of how the policy is written, next year the earliest is when it can be changed.
The cost of homes across the state remains high right now, too high for many people to even consider purchasing a home. This week, President Donald Trump floated an idea to try to make home prices a little more affordable in the short term, proposing a 50-year mortgage.
The plan would lower a home buyer's monthly payment, but experts say buyers would pay a lot more in interest over those 50 years. Linda Beccaro reports.
While 30-year mortgages are a fixture in the housing market since the 1940s, the Trump administration says it's considering allowing a new, longer 50-year mortgage.
The younger generation isn't probably going to end up with a house paid off.
I think it's a great idea. I think it makes more affordability for more people.
Barbara Guerriere, a home loan consultant with Valley Bank, points out, though, that you have to factor in the interest. Let's crunch numbers according to Fannie Mae's mortgage calculator. A $500,000 30-year loan with an interest rate of 6.3% gives you a mortgage payment of $3,101 a month. A 50-year loan at 6.8% brings it down to $2,932. Using that same Fannie Mae calculator, the total interest you'd pay over 30 years is $616,000. Stretching payments out over 50 years doubles the interest to more than $1.2 million.
You're paying increased interest towards that. It also slows up the buildup of equity in the home.
If you're likely to sell the home sooner rather than later, that's where smaller payments might pay off. This homeowner is originally from Bedford.
Even if they sell it, then they've still acquired equity, and real estate's a really good investment.
I think historically, most people aren't in their homes. You know, we always say that 7 to 10 year rule.
Linda Beccaro reporting. Another thing, the 50-year mortgage doesn't account for American life expectancy. The average age of a first-time home buyer is now roughly 40 years old. A 50-year mortgage may be difficult to underwrite, as the home buyer would be 90 before the home was paid off. And the average life expectancy is roughly 79 years old.